$2,000 a month, not from a job, not from selling anything, from a system that runs automatically, whether I'm at work, asleep, or at my kid's soccer game. That's the target. And this video is about how it's built. But I'm not going to stand here and tell you this is something you flip on like a switch. It isn't. It's a system you build over time, in a very specific order. And the order is what makes the difference between a portfolio that compounds and one that stalls. In this video, I'm going to show you exactly how the weekly paycheck replacement system is structured, why the sequence matters more than anything else, and what the math looks like when every piece is finally running. This is the video I've been building toward since the beginning of this channel. Let's get into it. Before I show you the system, I need to show you the problem it's solving, because without understanding the problem, the solution looks like complexity for its own sake. The standard retirement model works like this. You accumulate paper gains in a 401k or index fund for 30 or 40 years. And then, when you retire, you start selling shares to fund your life. A little every month, for the rest of your life. That model has a name. It's called sequence of returns risk. And it means that if the market drops in the first few years of your retirement, you're selling shares at low prices to fund your expenses. Your portfolio takes a hit from both sides, falling value and forced liquidation. It's the worst possible outcome at the worst possible time. There's a second problem. Traditional dividend stocks solve part of this. They pay you without requiring you to sell, but the math doesn't work at limited capital. A 3% dividend yield requires $1 million to generate $30,000 a year. Most people building toward financial freedom don't have $1 million to park in dividend stocks. The time horizon to meaningful income is too long. The weekly paycheck replacement system solves both problems. It generates income without requiring you to sell shares, and it does it at yields that make the math work at realistic capital levels. Without the NAV destruction I learned about the hard way, to understand the system, you need to understand one concept, the covered call. Plain English version first. Imagine you own 100 shares of the S&P 500. Someone comes to you and says, I'll pay you $50 right now if you promise me the option to buy your shares at a set price within the next month. You take the $50. Most of the time, the option expires worthless, and you keep the $50 plus your shares. That $50 is the option premium, and that's the income. A covered call ETF does this systematically at scale every single month. It holds the underlying index, the S&P 500, the NASDAQ, whatever the fund is built on, and simultaneously sells options against that position to generate income. That income gets distributed to shareholders monthly. Now here's the critical distinction, the one that cost me real money before I understood it. Not all covered call ETFs are built the same. Some use zero-day to expiration options, the most aggressive structure designed to maximize headline yield. These funds generate extraordinary-looking distribution numbers. They also destroy NAV over time. The income is real, but every distribution partially represents your own capital coming back to you at a lower share price. The funds in my system are built on a different philosophy. They sell options on a monthly cycle, not a daily one. They're designed to participate in index upside while capturing premium income. The result is a total return profile that tracks closely to the underlying index, with the income paid out monthly instead of requiring you to sell. Same market returns you'd get from a traditional index fund, paid to you as monthly income instead of accumulated as paper gains you have to sell later. That reframe changes everything. Here's where most people building an income floor go wrong, and where I went wrong before I fixed it. The instinct is to diversify immediately. Spread your capital across all your positions from day one. 6 funds, 6 allocations, 6 parallel DCA contributions every month. It feels disciplined. It feels balanced. It's actually the slowest possible path to a working system. Here's why. The moment that changes everything in a covered call ETF portfolio isn't the first distribution. It's the drip threshold. The drip threshold is the point where you own enough shares to generate at least one full share per month via automatic reinvestment. Below that threshold, DRIP buys fractions of shares. Compounding is negligible, nearly invisible. Above that threshold, every distribution buys a full share. That full share generates its own distributions next month. Those distributions buy another full share. The flywheel is self-sustaining. Spreading $600 a month across 5 funds in parallel means no single fund reaches that threshold for 50 months. 50 months of negligible compounding across every position simultaneously. The fix is to concentrate capital into one fund at a time until it crosses the threshold, then redirect the full monthly deployment to the next fund. 50 months becomes 39. 11 months of additional compounding, recovered from a single sequencing decision. The threshold for each fund isn't determined by yield alone. It's determined by share price and yield together. And that combination produces a sequencing order that isn't intuitive until you see the math. The 5 positions in the system in build order. First, GRNI. Not because it has the highest yield, it doesn't. GRNI goes first because its share price is roughly a quarter of the other funds. That low share price means the threshold is dramatically lower, less than $2,400 of invested capital before the flywheel crosses. At $600 a month, that's approximately 3 months. The flywheel is running in quarter 1. Second, QQQI. Highest yield in the system at approximately 15.5%. After GRNI crosses threshold, QQQI's yield advantage makes it the fastest subsequent build. Third, GPIQ, Goldman Sachs. NASDAQ, 100 covered call. Strong NAV stability, yield approaching 11%. Dynamic partial coverage strategy that allows uncapped upside on a portion of the portfolio at all times. Fourth, TPay, S&P 500 covered call with a 10% target distribution rate and 100% estimated return of capital on every distribution so far, validated by its sister fund XPay, which has a 17-month live track record and over $60 million in AUM. Fifth, GPIX, Goldman Sachs S&P 500 covered call, the most NAV-stable position in the system and the largest threshold to cross. Built last because it requires the most capital. But GPIX has also been accumulating the longest, and by phase 2, years of prior DCA will already be compounding. The rule is simple. Correct sequencing equals dollars remaining to threshold, not yield rank, not portfolio weight. Threshold. The system runs in 2 phases. Phase 1 is the sequential concentrated build, months 1 through 39, $600 a month, directed at one fund at a time in threshold remaining order, GRNI, then QQQI, then GPIQ, then TPAY, then GPIX. The rule is absolute. Do not spread until each fund has crossed its DRIP threshold and the flywheel is self-sustaining. Phase 1 is not a sacrifice. It is the mechanism. Every month that GRNI compounds above threshold, while QQQI and GPIQ and the others are still being built, those shares are generating distributions that buy more shares that generate more distributions. The compounding that matters most starts at month 3, not month 40. By the time all 5 funds cross threshold and phase 2 begins, the earliest positions will have been compounding at or above the flywheel point for over 3 years. The actual share counts and monthly distributions at phase 2 launch will significantly exceed simple threshold math. Compounding has been running silently the entire time. Phase 2 is where the weekly income cadence goes live. Different funds have different ex-dividend schedules. With all 5 positions self-sustaining, the income calendar fills in. Something landing in week 1, something different in week 2, through the end of every month, every week, automatically. The core problem with most income strategies is that they pay monthly, which means income clusters around the same dates every month. 4 weeks of expenses, 1 distribution event. That's not a paycheck replacement, that's a monthly deposit. Phase 2 is the paycheck, engineered to land the same way a salary does, week in, week out, while you hold. All 5 positions held in a taxable brokerage. All distributions reinvested through DRIP during the accumulation phase, buying more shares automatically, which generate more distributions, which buy more shares. The DRIP is not optional. It is how the compounding works. Turning it off during phase 1 is the same as turning off the engine mid-race. Here's the part most people skip, and it's where the system's real edge lives. Most income from investments is taxable in the year you receive it. Dividends, interest, capital gains, it all hits your tax return. Every dollar you pay in taxes is a dollar that isn't compounding. The income floor positions in this system were selected specifically because of their high proportion of distributions, classified as return of capital. This wasn't accidental. It was a deliberate screening criterion. Every position was chosen with tax efficiency as a core requirement alongside NAV stability and yield. Plain English, return of capital is not income. It's the fund returning a portion of your original investment. And because it's not income, it's not taxed as income. Instead, it reduces your cost basis in the fund. What this means in practice: during the accumulation phase, the majority of what these funds pay you arrives tax deferred. You're not writing a check to the IRS on income you're reinvesting anyway. More capital stays in the system, the compounding accelerates. GPIC's estimated return of capital component, approximately 88%. GPIQ, approximately 91%. TPay and GRNI, 100% estimated return of capital on every distribution so far. Those figures aren't guaranteed. Fund distributions vary year to year, but the structure of how these instruments generate income makes high return of capital a consistent feature, not an accident. There's more to the tax story than this, specifically what happens at the generational level when this system is passed to heirs. That's a full video on its own, and it's coming. But the foundation is this: the system is not just generating income, it's generating income in the most tax-efficient structure available to retail investors in an ETF wrapper. I want to leave you with the framing that changed how I think about this system entirely. Most personal finance advice points people toward S&P 500 index funds, and that advice is correct. The S&P 500 is one of the best long-term wealth-building vehicles that exists. The problem isn't the underlying index. The problem is the delivery mechanism. Traditional index investing gives you returns as paper gains. You can't spend paper gains. You can't pay rent with paper gains. Eventually you have to sell, and the moment you start selling, compounding stops for those shares. The income floor takes the same underlying index exposure and engineers it to pay you monthly instead of requiring you to sell. The total return profile is comparable. The delivery mechanism is fundamentally different. You're not doing something exotic. You're not chasing yield. You're taking the age-old wisdom of investing in the market and building a structure that pays you while you hold it. That's the Weekly Paycheck Replacement System. Here's what we covered today. 1. The problem: sequence of returns risk, and the capital requirement gap in traditional income strategies. 2. The solution: covered call ETFs that deliver index returns as monthly income instead of paper gains. 3. The architecture: a two-phase build. Phase 1 concentrates $600 a month into one fund at a time, in threshold remaining order, until each crosses its DRIP threshold, and the flywheel is self-sustaining. Phase 2 deploys in parallel, and the weekly income calendar goes live. 4. The tax edge: return of capital distributions that defer the tax bill during accumulation across a portfolio deliberately selected for that feature. 5. The reframe: conventional index wisdom, re-engineered to pay you instead of making you sell. This is not financial advice. It's a documented system built from my own experience, my own capital, and my own hard lessons. Do your own research. Understand what you own before you buy it. If this kind of architecture is what you came here for, subscribe. Every video on this channel goes deeper on one piece of the system. The next video goes deep on the return of capital tax structure. specifically what happens at the generational level when a stepped-up cost basis eliminates decades of deferred tax liability at inheritance. That's the part most personal finance content never explains. We're explaining it. Drop a comment below. Are you in phase 1 building toward your first threshold, or are you still figuring out where to start? I read everyone. I'm built and bankrolled. Let's get to work.